Ryan, why don't you pull up Amazon's margins real quick?
Well, yeah, I'd have more of a grin on my face than Stephen Hawking on Epstein's Island.
I'm off as a smug cock when he said that.
Wow, fiscal philosophy, you're not very smart at all. You screw up, cash flow kings. Dissector, you are an idiot.
Hello, everybody. It is Saturday, and looking at my watch, it's Saturday, 8 p.m. Eastern. And we haven't always been doing Saturday, 8 p.m. Easterns as of late. Some distractions got in the way. You have some vacations. But we're back, and we're closing out 2025 on a high note.
Literally.
Welcome back, everybody. Saturday, 8 p.m. Eastern, you could be doing a plethora of naughty activities. Now, Fiscal, what are some of these naughty activities that you could be doing that, let's just say, are not accretive to your lifestyle?
Well, you could be blowing all your money Black Friday and Cyber Monday shopping on the likes of Amazon.com and or going to Target and blowing $50+ minimum, bare minimum.
Can't go into Target and not spend $50.
It's the Target tax. It's very well known.
Mm-hmm.
You could be doing that, feeding your shopping addiction. You could be eating way too many candy canes.
Yeah. Wait, that's God. Way too many candy canes.
Rolling around in the snow, getting it in your nose, if you know what I mean.
You could be having eggnog at holiday Christmas parties and trying to hit on your work wife. Not good. No,
not a good
look.
She
slaps you. Not something you'd want to do.
Yeah. Especially if you do it in front of your at-home wife.
Yeah. Nothing you ever want to get caught doing. Many bad things you could be doing during this holiday season on CFK, but that doesn't matter when you're on this show. We only do positive things like not do fentanyl and good things.
Speaking of things, well, look at what's in the chat. Oh my goodness,
Blake what a Gil or what are we talking about? Dissecto. Talking idiots. Wait, what? Whoa. Whoa! Can somebody clip that and get that in quote of the year? No context there.
You heard it here, guys.
Yeah,
didn't even know that was a thing.
We do have a new channel member, which we greatly appreciate. Now, Fiscal, I had some time on my hands this week, and there happens to be a few new emotes that you can use in the chat. We have the Khmer emote.
Is that only for members?
Yes, only members can use these, I think. I believe so, actually. We have the Antonio emote. We have the Fiscal with a crown. We have AI Fiscal, and we have a picture of me looking disgruntled. So enjoy those new 5 emotes. The Khmer one was heavily requested, so go enjoy.
By the way, RIP MicroStrategy. Or just strategy, sorry.
Yes, there's no macro or micro at this point. But as per usual, with any sort of financial compensation on this show, we do anything for $1. It could be $2 or $80. It doesn't matter. We will dance for $1. What is the difference between us and some dancers at your local club? Not much, besides the fact we give you some financial education, not advice. I can't say advice. All that out of the way, we will dance and let Blake not dance.
Round two, here we go.
Thank you very much. I think that's Alex. I think he's been a channel member at Cantalupo. Appreciate it. With all that out of the way, we have a very good lineup of guests coming up for the rest of December, so be on the lookout for that. We have Fiscal. Are we doing any ad reads today?
No, unless we want to. Do you have strongman stuff in
We
the?
do. I do have a little bit of strongman stuff. I guess I could plug it if I wanted to.
Yeah.
This episode of Cash Flow Kings is sponsored by Strongman Personal Finance Tax Services. Fiscal, what's more of a pain in the ass than taxes?
Not a whole lot. I mean, of the things that are inevitable, nothing is more inevitable than taxes except for maybe death.
Yeah.
And boy, oh boy, do you want the right person in place for both of those things?
I
Now,
wouldn't want somebody that's a grifter to be doing my taxes, Fiscal. I don't want,
no.
people with
No.
the name that starts with O or real name starts with an F to be doing that.
Yeah. What I would say is, if you want somebody that knows how to prepare a tax return, that's a CPA, that's been doing this for a long time, that actually has the credentials and the credibility and has done our partnership tax return, so we can vouch that
We are customers.
we received our K1s, our filing went great, we didn't get audited.
Feds didn't show up at my house.
Yeah. So Strongman will take care of you.
Yeah.
And you can know that the job is done right.
In more ways than one, he will take care of you.
And I believe there is a 30-minute consultation.
A free consultation. That's 30 minutes of Strongman's time. You could even ask him his opinions on Dave's stock for all I care. Tell him we sent you. Yeah.
Indeed.
With all that out of the yes.
Yes. And if you do his services, he may or may not give us a discount on ours. So we need all the help we can get, guys.
Yes. With all that said, 2 links in the description. Go check both of those out.
Tell them CFKs sent you.
Yes, tell them the Cash Flow King sent you. We do get a large chunk of money. Once again, thank you to Strongman Tax Services for sponsoring today's episode. All right, with all that out of the way, all of our ad reads, we have to grift harder. Blake is back on the show with a very stylish hat because it's about 5 degrees in Canada. Welcome in, Blake.
It is very cold where I'm at. I think it's probably a little colder where you're at, but Midwest winter, I spent most of the afternoon outside, and even after a hot shower, I still feel cold.
It's 32 right now where I'm at. It's been
I feel you guys. It's 64 here. I'm dying.
Oh.
Yes. So HITI came out with a new store in Germany, and I got a lot of questions about it, like what my opinions were on it and everything.
We'll start off with the high tide because we all know that high tide barnacles are known for their great patience in our episodes.
In some ways, we are very patient, and in some ways, absolutely not.
Well said.
So this is an accessories-only store, right? They don't sell actual cannabis. I would love to know if there's an actual dispensary, like maybe right down the block. I would love to find that out. I have not done that sort of a deep dive, and it's Germany, so you can't just hop on Google Street View and just start poking around. German laws. So the business model worked very well, very, very well from 2009 up until 2019. When in Canada, they were an accessory-only situation, right? Mm-hmm. During that time, Raj started with 1 store and 2 employees. He grew that all the way up to about, I think, 8 or 9 stores. It's one of those 2 numbers over the course of about a decade. These stores were relatively high margin compared to what we're used to seeing. They had dramatically lower foot traffic compared to what we're used to seeing nowadays. But they were very successful. Raj made a lot of money. And then he took the company public. He made a lot of money as a sole proprietor before he took the company public. So I got a lot of questions about what do I think gross margins are going to be, right? Are we going to see 40, 50% gross margins like what the company was doing during that decade? Or are we going to see more 28%, 27%, like what the core stores in Canada target? I don't know, right? That's a sort of.
I would guess that it'll be higher if it's accessories only, because the accessories, the benefit to them is they are the higher margin product, and the The cannabis is just the thing that brings the foot traffic.
Right,
so
but we're in a situation where there's no loss leader driving foot traffic. You only have the accessories, and so you're sort of you can't like the core business model up in Canada. It can rely purely on word of mouth. It doesn't have to advertise. It has super sticky revenue because it has a loss leader model. They keep coming back over and over and over for the consumable, right?
Sure, but hear me out.
No consumable here.
I think now it's a little bit different because this is a kind of a new grand opening situation for an established brand.
Yeah.
When he was a sole proprietor, who heard of Canna Cabana unless you had one in your town or whatever? But there's going to be a lot of people wanting to check it out because they've heard of High Tide or they've heard of Canna Cabana, and it's gonna, there will be some fanfare, I imagine.
So I'm very curious what the gross margins will be. And that will be a big signal to us because, the Raj and the team, they get to choose gross margins. This is a retailer. They can just pick whatever gross margins they want. But they don't get to choose their foot traffic, right? One of them is a dependent variable. The other one is an independent variable. They choose gross margins that determines what foot traffic will be. So I'm very curious if they're going to go tight and aggressive and try to go for high volume and capture market share, drive neighboring stores out of business, that sort of thing, or if they're just going to try to stay profitable, establish the store, maintain positive cash flow, and not try for impressive same-store sales growth. I don't know what their goals are, right? I'm pretty sure they'll meet whatever their goals are. I'm not sure what their goals are here. And I do think consider this a test store. If this test store does really well, we could see like a dozen more stores get thrown up next year. What if 6 months from now, they look at the numbers and they're like, man, this Germany store is doing really well. We should just plant a dozen more, and then wait, because they know that eventually, cross your fingers, right? Culture shifting. It's a slow shift, but eventually the German government is expected to make recreational cannabis legal. And then all these stores can just flip the switch. And then instantly they'll switch to the brick and mortar Canadian model that we're used to, that has incredible sticky revenue, incredible foot traffic, all that stuff. That's the juicy business model, right? Yeah. This German business model that they're currently trying, I don't consider it hyper juicy. I consider it's probably going to be healthy. It's probably going to do quite well. I don't think it's going to be like S tier, like what the Canadian.
Not going to blow us away, huh?
It's not going to blow us away. Yeah, that's there it is. Temper your expectations. I don't consider this. I don't expect to be blown away. That's a good way to look at this. We might be, very possible. And Raj might be, right? Maybe he opens the store also expecting, tempered expectations, and 6 months from now, these numbers are just blowing him out of the water. I don't know. Tentative optimism. That's where I'm at with this. This could become a huge deal. Like it could be 3 to 5 years from now. We look back on what happened in the last month or something. And they're like, that was a pivotal moment. Like moving into Germany early gave them some edge that, we don't recognize now, but it becomes clear as day over time. I don't know.
We want to do some due diligence here. We could also take a look at this, like the one photo we got in
the German store.
Yeah, the German store. We have some snacks over here to the left. I see some Oreos, some Twix. I like the nice floating display they have here.
Yeah, I like throwing Twix in the freezer and then having them be extra crispy.
I see. Down here, I can't tell what this is. It looks like maybe bags or wallets, I want to say. You can put yours on it. I can't really tell what's in the glass here. I'd assume it's higher priced items, just by the way typical retail is. Over here, I could see
some high-end glassware or something.
Yeah, we got over here on the far right. I see. I'm no pothead, but that looks like a bong to me.
Good eye. No, it's a vase.
Oh, it's a vase. Yeah, I don't know the difference. A lot of people are gonna be upset at me. I think this is all bongs and glassware.
Yeah.
Now, maybe a stupid question here, and I'm gonna be the casual's advocate. If cannabis is not federally legal in Germany right now, it's only cleared medically. Who is going around and buying some of these bongs? Would it just be I guess.
So you can consume the medical stuff any way you want.
Okay.
You can use a vaporizer. You can
I
use a
see.
bong.
I
You
see.
can roll it into a joint. Like
I see.
it's medicinal. Just means that it passed like the quality inspection, but
I
there's no difference
I see.
in the actual.
There is a recreational market in Germany. They're just not allowed to operate in the way that they are in Canada.
Yeah.
In Germany, they operate more like you join a club. You're only allowed to be in one club, and then that is the hookah house you go to, and you have to consume your stuff at that location. I believe you're allowed to make purchases and take it home and consume it at home, but you're absolutely not allowed to consume in public.
That's somewhat like there's like there's another country that has a very similar model. Is it Holland?
Holland has had a very long tradition with it, like culturally, for years.
I've heard that they used to have like the designated zones where it's like, this is where you can do it, and if you're in this area, you can do it, but outside that, it's not allowed.
Yeah, they designate some tourist areas like in or around or near the red light district where they're like, yeah, if you're a local and you don't want to put up with it, I guess don't move to this neighborhood.
Yeah.
I have a friend who went to Germany for a while, and I'll have to ask how often he saw recreational cannabis usage there.
It's a Western Central European style country, so it's going to be a small percentage of the population. It's not going to be 30, 40% or anything. This isn't. Yeah. It's not super ingrained in their culture, but all of Western culture, it's everywhere, right? Mm-hmm. You go to any country that like a former British colony, if they speak English or anything, I guarantee it's there. It might not be in a high percentage, but cultural variation from one location to another, you're going to find it. Humans have been consuming this stuff for like 8,000 to 9,000 years. Mm-hmm. One of the other barnacles that I talked to, he regularly points out to me, he's like, I just see long-term bullishness that's been going back for like 8,000 years now, this ever increasing consumer percentage. It's a slow curve. It's a very, very gradual bull run, multi-thousand-year long bull run, right? But he keeps pointing this out. Like, he's like, hey, consumption rates just keep going up and up and up. This is just a fact of nature. Like we domesticated dogs and horses and cats, and right, we domesticated all sorts of stuff. And it's silly to ignore the fact that we also domesticated this one plant.
Imagine how excited Warren Buffett would be if he could compound for 8,000 years.
Oh yeah, yeah, for sure.
We'll talk a little about the stock price because, Blake, there were a lot of people when after probably our last episode around September, October, where people were talking, I'm not selling this until it hits $30. I see it going to 15. Unfortunately, the horses were held a little bit, and we peaked out about like $4, and then I guess you could say it went downhill from there. I mean, I don't know if anybody's really complaining if you're a long-term bull. Obviously, it stocks, but I think these are pretty good choices to accumulate.
It gives me a chance to accumulate a little bit more down here. Yeah. The one thing about being in a really volatile penny stock like this, like small caps, obscure, hated industries, all that stuff, they typically present you with some strong volatility, big opportunities. I regularly brag about the shares I bought at $1.05, right? I maybe have not explained the story of how I knew when to buy, right? And this sort of thing would have never happened to a mega cap or a large cap. So super tiny float, very few shares per day traded, right? So not liquid. High Tide's trading at around $1.30, something like that. One of the ETFs declared, hey, volume's too low, we're shutting down. We have to deleverage all of our positions. And so they sold, several 100,000 shares of High Tide over the course of like a week. And I'm watching the selling pressure. And then every day when the market closes, we get an update on the ETF's current holdings as they continue to try to unwind and dump everything as hard and as fast as they can. Yeah. And so I knew, 4, 5, 6, I don't remember exactly how many days it lasted, but there was a super hard bear drive. I don't even call it a run. It was a single sell-off from a single seller, and they were dumping like hundreds of thousands of shares per day. into an illiquid market, the share price tanked, and it tanked hard. And I saw that parabolic move, and I just set limit buys at like every penny. Like I didn't know how far down it's going to go, right? But I just set limit buys like all the way down. And so I knew the deeper it went, the more shares I'd get. Right? This sort of volatility opportunity would never have been given to me on an Apple or a Microsoft or NVIDIA. I mean, in the course of a week, I saw 20% drop. This was like mid-March 2023, right in there. So you can go back and you could probably find it on that chart. It'll say like $1.08 or $1.10. I'm not sure where the price actually closed on that one day, but it did.
There we go.
Yeah, mid-March, right. That was due to an ETF sell-off. That was due to a major whale having to unwind its position, being forced to and
it was Dividend, dude, wasn't
it? It was one of the few times in my experience.
Danny, if you're watching, I'm kidding. Just a whale thing,
We're not on good terms right now, Fiscal.
It was one of the very few times where I had a very clear understanding of why something was going up or down. Yeah. Super crystal clear. There were no questions. Why is this going down? So ask yourself, what's going to happen when it's done going down? Goes right back up. Yeah. It overreacts. It goes past. It goes right back up. Right. This is typical stock market behavior. Right. So do you guys want to start chatting about TA yet? Or maybe there's some.
There's a few questions regarding high tide. We got on Twitter. My one thing is, do we want to paint into a picture like how cheap it is right now? Because we did an exclusive a week ago.
What's the PEG ratio on it right now? Because I don't typically look at PE. I look at PEG.
Yeah, I looked it up a few weeks ago. It is, it's looking forward,
and really what I
0.8.
Here's a major secret, right? I don't actually just use PEG or PEGI. I actually also take EV to EBITDA and divide that out and compare that to the expected EBITDA growth rate and price to cash flow and compare that out and compare that to the expected cash flow growth rate. And so you have 3 different valuation metrics that I typically just average them all together. That's why when you guys ask me what's your estimate for intrinsic value, I'm like, well, I get a range. It's like $5 to $7, right? And it's kind of fuzzy, right? And it's because I'm looking at multiple valuation metrics, and I put different stock and different faith in each one. Like they're sort of good for different things, but it's also good to look at all 3 of them together.
So, how about I ask one question? Would you think that it might be fair to say that after this recent sell-off, where it is now, is possibly cheaper?
Yes.
Than when it was at that low earlier in the year, due to the acquisition.
100%. Yeah. So the acquisition increased cash flow, estimated cash flow by about 80%.
Right, and that was my main takeaway in the Twitter Spaces that we did, which is now up for members only. By the way, is that we look at the price now and it's like, oh man, if I would have gotten in at what was it, $1.80 or something, where it hit in the tariff tantrum thing, oh man, that would have been the time to get in. Well, actually, if you look at what the cash flow is after Remexian and factor that in, technically, it's cheaper now if you factor that in, to my understanding, and therefore, now is actually a great time to add, technically.
So we had the interview with Raj, right? And then the news hit and everything, and it had a massive rally. Like if you compare the valuation about 2 weeks before the interview, right? Because the news hit, right? News changes valuation. About 2 weeks before the interview, and then it had a 60% rally. It was actually cheaper at the top of the rally. Than down at the bottom before the 60% rally, because like we mentioned last time, cash flow went up by 80%.
Yeah.
And we're expected to see significant growth here, right? So that just because this one extra segment opened up with its own separate, growth rate and all that stuff, I don't expect the total net growth rate to suffer. It might even increase. Like The brick and mortar stores are going up by like 17 or 18% per year.
Yeah.
Like they're opening about 18% new stores per year every year. If the Remexian thing, if that matches, similar, 15 to 20% growth rate, double thumbs up over here. I'm going to be very happy with a 15 to 20% growth rate for the next, 10, 20 years.
Yeah.
That's a compounder. I'll get into that.
Yeah. A few more things. A few. Next earnings is going to be estimates are around February 4th. Do you see, first of all, how do you think the earnings are going to look? Because it says here, it's for the quarter ending October 2025. So obviously, the weather, it's a big impact. Also, do you see any like future catalysts potentially? Obviously, the Trump one's always the big skeleton in the closet that could unload at any time. But
so the U.S. could always change its laws that would produce a massive rally. I mean, that's the rally everybody who gets into cannabis right for the last decade has been.
It would be the
about.
MOAS of.
It might even be the MOAS. Like seriously,
is it inevitable to happen? You think?
Eventually,
on a long enough time scale.
Yeah. I believe we've already seen. Okay, we saw a major one in 2012, but like no one was paying attention. 2012, 2013, right in there. There was a huge cannabis industry-wide rally. 2018, 2019, Canada legalized, triggered a second massive industry-wide rally. Okay. Joe Biden got elected on a platform where he barely mentioned cannabis. Barely. But the Democrats got control of the House and the Senate and the White House, and cannabis rallied super hard on hope and hype. What do you think is going to happen when the actual laws change? It's going to be an event. Okay. I don't know how high things are going to go. Yeah, but it's going to be an event. And all I know is I'm just going to get pre-positioned into high tide, fantastic company, and eventually the event will happen and I'll have a fantastic return. Yeah. And I'm just patient, right? That's my whole thesis. Yeah. Killer CEO, killer business model. Everyone else is panicked about tariffs and things going up and things going down. I sleep great at night. Yeah. And I own a tiny little obscure small cap.
Yeah.
Sleep great.
You got to be patient. That's what you've reiterated from like episode 1 with this stock. And lastly, we had a question from John Brown, who's a viewer at Joan, maybe. He said, explain to us, Blake, why High Tide can't be acquired, or if so, what risks it entails and what Raj might do in today's podcast.
Oh, yeah. I needed to sit down and watch that podcast. I was too busy. Oh, wait. No, he means today's podcast that I'm on right now, not some random podcast.
I think.
Yeah, he's asking you to answer that question on today's
podcast. Okay.
Yeah.
There for a second, I thought he was telling me there was a Raj interview that I missed.
That would be unfortunate. Especially if it was supposed to be here and none of us knew about it.
Yeah. It's very difficult for a competitor to buy out High Tide because each of the Canadian provinces has their own like store limits, and High Tide is already at or close to the store limits for several of the provinces. And their primary competitor, like the only one who hasn't gone out of business yet, Sundial, who owns Value Buds, the other retail chain of discounters, all the non-discount chains, they're gone. They all ran out of business. They're done for. There's a handful of small mom and pops hanging on, like a couple thousand stores all across Canada. But all the corporate entities, they're done. They drowned. There's none of them left. There's only two. Sundial and High Tide. Sundial also owns a bunch of retail stores, and those retail stores happen to be in the same provinces that Canna Cabanas are in. So if Sundial is gonna step in and buy a bunch of Canna Cabanas, they would have to like announce the buy, sell off a boatload of stores, and then complete the buy. Like it would be very difficult. It'd be complicated. It would be expensive.
Yeah.
It's very likely to fail, right? Because like the whole point of doing this is to produce something on the far end of it that's actually like a beneficial, positive thing. Like you want to end up with a better machine at the end of the day, not a crappier machine. And by mixing and matching like this, you're probably going to end up with a crappier machine. We got basically two fine-tuned race cars that are not like one's all metric and the other one's all standard. So you
Does Sundial still have their 5% stake?
I have not been as sharp on that as
I will look it up.
Yeah, look it up. I believe that they sold most of their position, and it was announced during their last ER.
Okay.
Please check that because when it hit, I was very busy with life and I didn't pay much attention to it. I just heard Sundial.
Okay, so from most recent filings, it went from 5.4 to 4% around there.
Sundial sold some more, but they're not done. They're not out.
Took them gains.
You see, Zach has heard me talk about this rally for like 5 years now, and he's hearing it too from not just me. He's hearing it from everybody. He knows that eventually there'll be a mega rally, and during the last mega rally, right? If anybody in the world believes that there will be a mega rally, it is Zach George. During the last mega rally, he diluted his own shareholders for $1.18 billion. What do you think he's going to do during the next one? He's going to dilute them for as much as he can.
Yeah, I would say he's not buying back shares.
He's not buying back shares. That's right. So what I think he's going to do is during the next mega rally, he's going to sell his high tide shares near the top or on the way up, something like that. And then he's going to brag about how awesome his financials look. And so he's going to set himself up to have a magic quarter, right? Everything will be rallying. He'll be selling into that rally. And then a couple weeks after that, he gets to produce an earnings report that just looks fantastic because he sold a bunch of assets for a huge gain just like a few weeks beforehand during the rally. Yeah. He's going to do that to improve his financials temporarily, right? This is tempo boost. And he's going to dilute his own shareholders into that good news. Okay, this is Zach George. This is his playbook. There's nothing really new about this. I've seen him do this once already. I expect him to do it again. He comes from a Wall Street background where they do like loan to own, right? They hand out loans. They get a hold of your shares. Like let's say they'll convert the loan to shares and then get a seat on the board and then intentionally mismanage the company and then get more shares, right? They mismanage it down into the gutter, buy up 51%, gain control of everything and take all your assets. So he's been doing this repeatedly for years. This is his business model. It's predatory. It's actually not that horrible, but it's a very difficult path to go down. Like he can absolutely find strong long-term success doing this because he's buying these assets up at like pennies on the dollar.
Yeah.
But they come with a drawback where they already drove their first owner out of business.
Yeah.
So he's got to work some magic and make them actually profitable, right? Is he going to buy out High Tide? I don't think so. I think he has already proven he's planning on continuously trading this position. There's been rumors for many years that he is the reason that High Tide drops the day after every earnings report.
Yeah. And
that, maybe he's the reason that, he's busy selling off 300,000 shares into the news. Whether it's good or bad news, 9:32 in the morning, 500,000 shares hit the market. Boom. Selling right into that bid.
Yeah.
Slamming it.
That
could be somebody else. I don't know, but somebody has a history of just crushing High Tide share price the day after their earnings. And I don't really know or care because I believe in the weighing machine, right? Yeah. Not the voting machine. That's volatility. I believe in the weighing machine. I'm a value investor. I'm here for the long haul. I'm also chose this company specifically because of the mega rally thesis, right? It's always been part of it. So every few months when I come on here, I try to hit you with another like a revelation to my thesis, right? Yeah. Business model kicks ass, Raj kicks ass, all that stuff. Since the last time I talked to you, I think I came up with a conclusion that it might not be correct, but I think it's probably pretty true. I think Raj suffers from imposter syndrome. And I think that is why he's so crazy driven, because he is unable to live up to his own standards. And throughout history, there's been a lot of people that have gained massive success because they were unable to live up to their own standards. I'm talking Isaac Newton, Barack Obama. These are the type of people that suffer from imposter syndrome. They typically go places. Okay, not all of them do. Some people are crippled by it, but the ones who use it to motivate themselves, they end up named Isaac Newton and Barack Obama. You just do a Google search on famous people with imposter syndrome. Not all of them are actors. When I first Googled it, I was like, man, there's a bunch of actors on here. Yeah. And I think that's because they're professional liars. That's a whole separate problem. So I think Raj suffers from imposter syndrome. I think his internal drive is relentless and endless. And this is exactly the type of characteristic that you want to find in a CEO, because you know that when you're asleep, he's not sleeping.
Yeah.
He's out there doing stuff.
Fun question, because I was thinking about it earlier today. Should we reach out to have Zach George on the show? And I think the answer will be interesting.
I don't think you want to have him on the show, but you're welcome to try.
Let's hope he doesn't have mob connections either, with the way you kind of just exposed them. But
so Paul, I noticed Paul made a comment about how I was describing an industry in decline with 2 surviving players.
Sounds like a duopoly, which if you had the cola wars, drove like RC into the ground and a bunch of other random colas that don't exist anymore, and the 2 survivors, Coke and Pepsi, if you would have bought both of them or either of them back then, when like Buffett was buying Coca-Cola, you would have done really well to today, right? Mm-hmm. In that example. And it's a different product, but kind of the same concept. Like the other brands are, floundering, or they're really fragmented and really can't consolidate anything. And there's 2 clear leaders, and those are probably going to be your Coke and Pepsi of the, and you're going to have basically functionally a duopoly, maybe still some smaller cottage brands out there, like the Jones sodas is of the weed world. But yeah, it doesn't mean the industry is in decline because the smaller brands are failing, I don't think.
Well, we did have a period of like Wild West gold rush craze. And so maybe decline's not really the right word. How about let's go with normalization, right?
Consolidation?
Consolidation, 100%. This is consolidation. Yeah. We're seeing the fiercest competitors rise to the top while everybody else fails. Yep. We're not seeing the entire industry decline. In fact, Paul, if you go look it up, in Canada, people just keep steadily smoking more and more and more. It's like keep grinding up at this. It's
pretty soon they're going to have more weed than lung in there.
Right. So there's been a lot of famous duopolies that we're used to seeing, like Visa, MasterCard, Home Depot and Lowe's. Even though Menards exists, also that's an example of a strong duopoly. Don't invest in Planet 13, that's for sure. God, what a horrible business model. Even if Planet 13 had good financials, trash business model. So anyways, I think that this is just consolidation. And because of we have 50 states in the U.S., we won't see this period of consolidation in the U.S. until those players are allowed to compete across state lines. Yeah. So we have 50 separate markets in the U.S. We have one consolidated market in Canada. So that is why Canada is allowed to be this like hyper competitive thing, because they're finally allowed to fight in a natural way.
Yeah. Like you can have a real duopoly there, but you couldn't have that here because of the way our stuff is different. Yeah.
Right. Not yet. Eventually it could happen.
But who would be the natural ones to step in and fill that void? It kind of makes sense.
So I view industry consolidation in general, like all industry consolidation is like you dump about 100 gladiators into the ring and then you like helicopter in and dump in a bunch of weapons, and they all got to run around and not get stabbed on the way down and scramble and pick up weapons off the ground. And then they all have to stand each other and fight to the death like Jet Li the One. There can be only one. Only in reality, most of the time, there's 3.
It's Thunderdome. 2 men enter, 1 man leaves.
Most of the time, these industries consolidate down to 3. Sometimes you get 2, right? Sometimes you get, Visa, MasterCard. But most of the time, industry consolidation, after a period of strong cannibalism, you usually end up with 3 players. And in Canada, we have 2 right now. And then there's a bunch of growers, right? We have 2 retailers that have successfully, viciously consolidated everybody else into bankruptcy. And then there's the growers, which it's a slower process, but they're viciously consolidating as well.
Yeah.
Paul had another question about
Paul's talking about the lip pillows. I think that's a different
I hear a lot about gummies and stuff. I don't know about like lip.
But there's not like a pouch or something for
no,
weed?
it's like gummy bears, only with chemicals in them. Like gummies.
Weeds.
I think he's basically talking about like THC zins or something.
Yeah, he's talking about like tobacco pouches only with cannabis. Maybe.
It's a good idea, Raj. Listen up on the.
Hey, let's pitch it.
Yeah,
we only want $1 million for this idea, Raj. What do you think?
We just want our StreamYard covered. All right, are we talking? We got to talk TA because we're like 45 minutes into the episode.
Eager to talk to you guys about technical analysis for like a year now.
Yes,
and I think it's something that I know the two of you. You're investors. You're not traders, right? And you recognize that
this year, I think I've done a little bit more of the trading because like I've done some like options, like buying and selling, but it's more vibes than actual chart reading.
Well, and you're not taking like 90% of your net wealth, consolidating it into a single account, and then pushing trades. No, you're investing and happen to be taking some trades.
Right. Yeah. That's very true. Yes.
Sure.
That's fact.
So there was a period in my life when I was like, man, I want to get really good at trading. I see other people can be good at trading. I know it's hard. I mean, I read a bunch of books years beforehand. Like as a teenager, I wanted to get into markets, read a bunch of books on how markets work. And then the pandemic hit, and one of the hobbies I was like, oh, I'm going to teach myself how options work, and I'm going to teach myself how to become a better technical trader, right? Those are the two goals that I set. And I met both of those goals, and yet I still don't actively trade every day, right? Why? Okay. So a lot of it has to do with my personality and my psychology. However, I learned a whole lot of things along the way. And I think a lot of the life lessons that you learn as a trader, you can also take over to other aspects of your life. Okay. So let's talk about the history of markets and why it's so crazy, right? And so you titled this whole like, let's learn TA, follow my guide,
free course.
Three easy steps, right? Follow this indicator. When it does the ding, you buy. Yeah, none of that. I'm not going to talk anything about that.
Is it a bull flag? Is it an uptrend? Is it a downtrend?
Oh, this candle pattern and that candlestick pattern.
Is it a head and shoulders? I don't know.
Yeah. So most of that, not all of it, most of that is just a distraction. Most of that is not actually going to help you. Okay. And believe you me, I thought everybody who gets into trading thinks, man, if only I could just learn how to use this indicator just a little bit better. Even once you know how to trade really well, if only I could just use this indicator just a little bit better. And that is not the type of thinking you want to get into. Okay. So let's talk about why, right? So I should probably share my screen. Let me figure out how to do that.
Just press the present button right next to your picture at the bottom.
Oh, press the present button. Okay.
Yeah.
Technical difficulties with technical analysis.
The sector coin.
It's a grift we can get into for 2000. I'm telling you guys, 2026 is the year of the grift for this show. We're gonna get monetized on Twitter, and bad things are gonna happen.
Okay, can you see my window?
Yes, it's up.
Okay, so you see Einstein on there. Okay, cool. So we're humans, and we like patterns. We really like patterns, right? We like it when things are predictable. Yeah. We like it when we can like look at some evidence and make a decision.
Our love of patterns is why we see a face on the moon.
Yeah, yeah. It's both a huge asset and a huge problem. Like we are hardwired to find patterns. We are pattern-seeking machines. Okay, and so we sort of believe, the definition of insanity would be to look at a pattern that you've seen 1,000 times before and say, you know what, this time it'll be different, right? And that's actually exactly the attitude that you need when you're in markets, because markets are probabilistic, right? So you can read this chart. It says cumulative average excess returns, days from an earnings announcement, right? You see price action and reaction to the news. When the chart, all the way over on the far left there, when zero timed out, although on the chart it looks like -20, if you were to buy and sell shares on that day, you would have to adopt a probabilistic outview of like what the markets are going to do, right? It could both go up, it could go down, it could stay relatively flat. All of these are options. Any of these outcomes could happen, right? In fact, the belief that any of these outcomes can happen is so ingrained in the entire industry that the entire Black-Scholes equation that we use to calculate the value of options is based off of this core concept where anything can happen, and the upside is just as likely to happen as the downside, according to Black-Scholes, right? And on a statistical average over a long enough time frame, that's true, right? However, we have this issue here where we have the law of large numbers and the law of averages are sort of competing with each other, right? So you flip a coin. What are the odds it's going to be heads and what are the odds it's going to be tails?
Roughly 50-50.
Yeah, right. Okay. So, however, you flip it 499 times, and it's been tails every time. And you checked, it's not a double-tailed coin. It's a regular coin. It's weighted normal. Ryan is not pulling one over on you, Fiscal. It's a normal coin. What are the odds? Either of you can go ahead and answer. I know I just cited Fiscal there. What are the odds that when you flip it for the 500th time, it also comes up tails?
Well, that's a complicated question, but on
it's
each
50%. I did this
individual, on each individual flip, it's always 50%. Yes.
Yeah.
Yes.
So you know that there are two things that are true here, and they say absolutely opposite things. One says it's still 50-50. Doesn't matter.
Yeah.
The other one says, man, there's been 499 of these, and they've all been tails. And the coin's fine. We checked. It's not a cheater coin.
Yeah.
It should not be 50-50. The next one should be heads. It has a slightly higher chance of heads than tails, like 51-49. So both of these concepts are both diametrically opposed to each other, and they're both true, and they're both correct at exactly the same time.
That's what I meant by that's a complicated question.
It's all 100%, right? And that's why I use that as an example, because the coin flip example is one of the best examples that humans have for understanding probabilistic outcomes. And the fact that you can be many flips deep into a series.
And I mean, so like, if somebody else like entered that room and didn't see any of the previous 499 flips, to them, like the 50-50 is obvious, right?
Mm-hmm.
But to you, who just saw this unbelievable streak of 499 in a row, you're like, it's got to come up heads at some point here, right?
Right.
We did a little poll. Yeah, that's roulette theory.
Okay.
Yeah, which and I think the concept of something being due doesn't necessarily change the statistics on any individual like spin of the roulette wheel or anything like that, because it's still the same like kind of like randomized physics at play, right?
Yeah.
But can it really land like 00 an infinite number of times in a row? No, at some point, right?
Yeah. So let's go one layer deeper on this onion. Okay. So if you get into like strategy games hardcore, like me personally, I've been addicted to strategy games my whole life. So that meant I also went out of my way to go read a bunch of books on game theory. And if we look at markets from a game theory perspective, game theory tells us some very interesting things about the system we're forced to play in, the environment. Okay. So game theory talks a lot about the quality of information that players have. And there's these two axes, right? And one of them we refer to as perfect. And the other one we refer to as complete, okay? So in a perfect setting, all of the positions, right? Hang on, let me make sure this is correct here. Battleship, I don't know. Yes, in a perfect setting, all of the board positions, but you don't know your opponent's goals. Sorry, that is a complete setting. In a perfect setting, you don't know your opponent's goals, but you know what their positions are. Things that are less perfect are poker, investing and trading. Things that are more perfect are chess and checkers. Things that are more complete are Battleship and tabletop war games. You know what your opponent's goals are when you play Battleship. It's to sink your battleship. You don't know where their battleships are, but you know what their goals are. Same with chess.
Yeah, poker.
You know what your opponent's goals are in chess. Super
Monopoly,
clear.
They want to win all the money, like
Yeah, but what you don't know are like their plan of attack, right? Their goal is to take your queen, is to take your king, is to win that game. Force checkmate. You don't know what their actual goals are in between here and there, right?
Right. Yeah.
Whereas there's this concept where if you're playing a game that is more complete and more perfect, right? Think tic-tac-toe. There's very few edges in tic-tac-toe. There's basically, it's a solved game. There's no actual edges.
Yeah, Connect 4 also is a solved game.
Connect 4, yeah.
Best game ever.
Right. However, markets are way down on the opposite end of that. There are many, many ways to find successful edges in markets. Okay, but the problem here is humans, we suck at dealing with low information games. We suck at this, right? The reason we suck at low information games is back to this. We believe that we should see the pattern, and then on the outside of that pattern, on an outcome for that, we should have a certain result or a range of accepted results, right? And this says that's not going to happen, right? This says you should not really put a lot of faith in that. You should actually believe that the pattern is wild, or maybe even better, that there is no pattern. Okay. Ooh, yeah, wild. Okay. So going into this whole conversation, I wanted to frame this right, where we have to understand that we're playing low information games, and we don't have all of the information. We don't know what type of game, because remember that many edges thing. There's many different strategies available to our opponents, every other market participant. We don't know what strategy they're using. We don't know how much money they have. We don't know how many shares they have. We don't know what the plan is, their perceived edge, their tactics, none of that, okay? We don't know any of that, and we're not used to dealing with an environment like that. Very few games that humans play, cards, dice, tabletop strategy, anything, board games, very few games are both incomplete and imperfect. It's rough. Okay, nobody likes to play those games. Okay. So here's a quote by Jesse Livermore. This guy will come up again, especially if you study trading. Because the more you study trading, the more you will bump into Jesse Livermore. There is nothing new in Wall Street. There cannot be, because speculation is as old as the hills. Whatever happens in the stock market today has happened before and will happen again. Okay, have either of you heard of Jesse Livermore?
Being honest, no.
No, okay. If I had asked you that question 100 years ago, you'd have said, absolutely, I know who Jesse Livermore is. He was the Michael Burry of his day. He made so much money off the panic of 1907 that it made him famous. Like okay, so this, you know what? Let me talk about Jesse Livermore later. I'll rant about him when the time comes for him. So there's this concept here that he's talking about where he wants to focus on, where I want to focus on, where he's talking about because of human nature, because human nature doesn't change, markets don't actually change. Volatility happens, they go up, they go down, new people get involved. Markets never change, okay? It's sort of like the intro and Fallout when they're like war never changes. You know, it's the same story. You hear it over and over again. It rhymes all the time, okay? So fortunately, right, this thing with the free markets, right, it's actually spawned up a couple of places, mostly independently from each other. So in the 1590s, tulips made it to the Netherlands. Yeah, you guys know where this is going, right?
Mm-hmm. Tulip mania.
Tulip mania. About a decade after tulips made it there, trading for tulips had become so fierce that the Dutch East India Trading Company opened the world's first stock market so that they could trade tulips. I mean, a few other commodities too, but like tulips was part of that.
The meme coins of the day.
The meme coins of the day. 1602, right? More than 400 years ago. Nothing
I'll
new.
take your heart coin and raise you a tulip.
Right? So that the product shows up in 1590, 1602 the market opens, 1636 tulip mania strikes. Bad. Okay? People lose their everything, you know. This is the world's first parabolic rally. Like no one has ever seen anything like this before. I mean, sure, if you go back to the Roman era and stuff like that, there were definitely commodity squeezes, but not like this. Not over a meme coin. Not over Beanie Babies, basically. So that event was written about in detail, along with the entirety of how the stock market works, in 1688 by a Spaniard who lived through a lot of that. He lived in the area, right? This is Joseph de la Vega. He wrote a book where he specifically talked about how he studied the stock exchange, its participants, and the shareholders. He talks about options, puts, calls, future contracts, margin, bull and bear conspiracies, right?
Imagine going all in tulips on margin. The mayor would love it.
People did. Okay. People did. Okay. So this is behavioral finance and technical analysis. This is, I believe, the world's first book on the topic of technical analysis. I've never read this book. Okay, but this is the world's first book. All the way over on the other side of the planet, Japan. Okay, so tulips was the Netherlands. In Japan, it was rice. In the 1300s, in the early medieval era in Japan, rice and everything, all the trading, all the markets was super centralized by regionality. So all of the local lords, they had the money. So the markets were all like right out in front of the lord's house, basically. Right outside the castle, there'd be a market. Very centralized to your region, right? So there's many, many markets overall in Japan, but there's not really very many in total, right? There's sort of an even distribution of them, and they're all camped up right next to the high lords. Fast forward a couple hundred years later, the markets got decentralized. Markets started cropping up all over the place in the rural areas. All the workers got a hold of markets. It was a huge boon. Okay, a couple hundred years after that, late medieval era, there's a massive caste of merchants. And although officially they have the least rights and they're in the bottom of Japanese society, they actually have the most money. They have the most power. So it's a very complicated situation. In 1710, in the 1600s, around 1600, the rice trading got so fierce that people started like a tradition of technical analysis based off of price action they were writing down on like slips of paper, essentially. The locals, right? Nowadays we have market makers. Back then they had local traders, locals, same thing. They would make a market. They would keep track of price action over many days so that they would know essentially what fair value is. They would always have a recent fair value book that they can compare to. Other people that would walk up to them, they wouldn't have that unless they were a serious everyday trader and they could come in and check what the price is every day. They would never have the ability to build this book, a record of price, right? The locals had that book. Every single one of them, they kept a record of the price over time. That way they wouldn't get screwed by seasonality and stuff like that. So that spawned this subculture within the caste of the merchants that were, their whole deal was trading, right? They perfected this industry, this sub-industry 400 years ago, trading rice. Nothing new has changed in the stock market. Eventually, it became so impractical to trade that much rice that they opened their own futures market in 1710. The entire Japanese stock market was so that they could trade rice more efficiently. So they had slips of paper, they started trading the paper, receipts, all of that, okay? This guy wrote a book about it in 1755. And in this book, he mostly focused on psychology. He did not focus on technical analysis, right? However, he made all of his decisions off of numbers in a book. Let this sink in, right? All the way back in the beginning, when technical analysis first had its start, it's just dudes staring at numbers, looking for patterns. It's that simple. It's humans and patterns and numbers. However, the extremely experienced people, the one who've been doing it for long enough, the one who actually found success, every single one of them talks about psychology. They all talk about like the psychological aspect of the market. Every one of them. All right. Charles Dow, you may have heard of Dow theory. Right? So we talked about Netherlands, we talked about Japan, the United States. around 100 years ago, a little over 100 years ago. I know you guys know about the Raging 20s, right? Everybody and their brother was crazy about the stock market. Shoe shiners were giving out tips, all that stuff. Well, a lot of that started...
Street sweeper, shoe shiner, they were all making money in the stock market, hand over fist.
Yeah.
Who knew?
A lot of that started in like the 1890s, and there was a big boom in the economy, and this is not the first time it happened. Remember, if it's happened in the past in the stock market, it'll happen again. But there was a wave of people trying to sell books on TA and how to navigate the stock market, how to pick winners, how to be a value investor. All of those concepts, people were already writing about it 120, 130 years ago. It just wasn't as clarified as it is today. So Charles Dow was one of the first people to come along, and he clarified things. He talked about cyclical investing. He talked about seasonality. He also laid the groundwork for like basic momentum-based technical analysis that we use today. You're going to hear me say that a lot, momentum-based technical analysis, for the next few minutes. A lot of his stuff was published in the Wall Street Journal, like over the course of a couple of years. You can actually go get a book on it. It was published in 1903, The ABC of Stock Speculation by S.A. Nelson. He sort of consolidated everything that Dow said and put it in a book. But Dow talked about accumulation. He talked about distribution. He talked about markup, right? These are core concepts, right? Why is retail called retail? Do either of you know?
No.
There's an open secret. Why is
yes.
retail called retail?
Because they pay retail price?
Because they pay retail price.
Oh,
that is 100%
the answer. I was just guessing.
Right. The professionals pay wholesale. They buy at the bottom with bravery and courage and guts, because they know it's going back up. They know where the bottom is. They have technical analysis to help guide them, right? They have a mental framework. You're going to hear me say that. They have a mental framework that helps them view those numbers in a way that actually makes sense, where they can get consistent expectations out, where they can look at numbers and say, hey, I think this is going up. And they can be right more than 50-50, maybe 51-49, maybe 55-45. But if you're right more than 50-50, that's a trading strategy right there, because you can just push the law of large numbers back to the coin flips. If you know that coin's going to flip 55-45, get out your money, boo. Get out your money, because that is going to make you super wealthy if you can consistently hit 55% winners. Okay, so there became a rather large industry of these guys that came out, and they're all trying to sell books on technical analysis. Another one that you come across is Elliott Wave Theory by Ralph Nelson Elliott. Okay. I do not have nice things to say about this guy or his theory. Basically, of all of the TA like flavors or brands, this is one of the worst ones. I can come up with 1,000 ways to describe why this is bad. The fundamental core reason is that markets are fractal. And when you're looking at a fractal market, you cannot tell what the peak is until after it has passed. Right? It's impossible. Anybody who tells you that they are timing the top and they know they're timing the top, when they do that, they're lying to you. They're lying to themselves. They think they're at the top. They think it might go down, but they don't have the confidence of knowledge until after the fact, right? That's the problem with Elliott Wave. You don't know that you hit the peak until 2 peaks ago with confidence. Last peak, sure, with no confidence. 2 peaks ago with confidence. Well, what happened 2 peaks ago? Well, its share price has gone down like 30% since then. So now you finally have your sell signal. Whoops, it's too late. So Elliott Wave, because it's fractal, because it's very easy to choose the wrong points, right? Everything is super subjective. I do not put any faith in Elliott Wave. However, Wyckoff, right? Wyckoff sort of cascaded on this whole, the Dow stuff. Accumulation and distribution became sort of his bag. And he talked about the markup. He talked about accumulation. He talked about distribution. But one of the things that Wyckoff did that expanded on Dow is he actually talked about what to look for to tell the difference between accumulation and distribution, and what things look like when they're just plain in the markup phase during a bull run, right? Can you tell the difference between what a bull run looks like in the middle of the bull run and what the bull run looks like near the end of the bull run? The short answer is during accumulation, things regularly do not look bullish. During actual accumulation, things tend to look kind of flat. And then right before it takes off, often, not always, often there's a spring where it'll try to go down. It'll fail the test down and it'll go up. Okay. I've heard people refer to this as a look below and fail or a look above and fail. It will look below, it will fail to find volume down there, and it will go up in a quest to find new volume. Unfortunately, we don't know how far it's going to go up. Right? We don't know if the bull run is going to extend forever. But we do know that in order to find new volume, it has to cut all the way across old volume, right? So you'll see, can you guys see my screen pretty well?
Yeah.
Turn off malware bytes. In order to find, if it can't find volume here near the word spring, and it just recently chopped its whole way down here, okay? In order to find new volume in the up direction, it has to go all the way into a new area, right? It has to go past the old extremes. So if price really is vigorously trying to find volume, if it's desperate to find volume, it'll rip all the way from the bottom of a range to the top of a range just to find it. Same with the other way around. It'll rip all the way from the top to the bottom and then pause right there on the floor because that's where it found volume. A lot of that's because of market makers. No, there's a tab on Elliott. There's another tab on Elliott. Elliott wave principle, you'll see a lot of people swear by it. I don't like it. And then we're back to Jesse Livermore. Okay, so during this era of the 1890s and early 1900s, in addition to a bunch of people writing books and trying to sell books, there were a handful of people out there getting famous, doing stuff. Jesse Livermore is one of them. One of his famous short positions, they cite it here in the wiki, it reminds me, because I read a couple of his books. He heard about the San Francisco earthquake. It came across the wire. There was an earthquake in San Francisco. However, no one on the East Coast, the message didn't include how bad it was. Nobody knew how bad it was. So the moment he heard there was an earthquake, he ran to the local telegram station and he dialed up his broker and he sent a message and he said, short that railroad hard with like everything. And he made a bucket of money on that short.
That's just cheating at that point.
Well, nobody knew how bad the earthquake was.
Yeah.
But he knew.
There was a guy, and he might have been full of shit, but he said, remember when that 737 had the plug blow out?
In Alaska?
He was like, is it insider trading if I short from from the airplane that just had a mechanical problem? Yeah. It just reminds me of that story so much because it's like I was literally on the plane, like nobody's heard about this yet, and I shorted Boeing.
Yeah. So Jesse was the world's first quantitative trader, and I don't say that lightly. Okay, in an environment where there's hundreds of these guys out there, and they're all trying to form their own special version of technical analysis. This is comparable to like China with Kung Fu. Like 100 plus years ago. Like everybody has their own special secret Kung Fu. They all tell you theirs is the best and everybody else sucks, you know, and in reality, they all just doing the same crappy white crane techniques. Okay. 120 years ago, there was a huge crowd of technical traders and they're all telling you that their Kung Fu is the best. However, this guy's Kung Fu was actually the best. Okay. There are other people who also had quote unquote the best Kung Fu, right? But this guy's Kung Fu was very clearly the best. Okay. He got so good at his Kung Fu that he could fake a bull run. He got so good at faking bull runs that people hired him to fake bull runs. Like JP Morgan hired him to get out of a stock. He bought a stock, it went down. I don't know what to do. I don't want to lose money. I don't want to take a loss. I'll hand Jesse Livermore $10 million. In 1930, 19 teens or whatever, 100 years ago money, $10 million. It says, can you get me out of the stock? JC says, sure, I'll get you out of the stock. Jesse's plan was to fake a bull run, right? And how you fake a bull run is For anybody who's never come across this, they literally had to invent the SEC for Jesse Livermore. That's how destructive this guy was. To fake a bull run, you call up broker A and you say, I want to buy 10,000 shares. And then you call up broker B and you say, I want to sell 10,000 shares. Now, you personally are delta neutral, but you're playing on two different accounts and your brokers don't know that the other broker exists. Okay. The rest of the market, they see 20,000 shares of volume with no significant price change. So at the end of the trading day, you step in and you force price up a few cents right at the end. Boom. Now it posts at the end of the day, volume went up, 20,000 shares extra, price went up. Okay, cool. Next day, you call up 4 brokers, 10,000, 10,000, 10,000, 10,000, half short, half long. You're still delta neutral. You still don't actually care what happens to the share price. At the end of the day, you buy it up just a few pennies, force the price higher. Okay, to an outside observer, they don't know this isn't a real bull run. All they see is volume climbing and price climbing. Okay, day 3, you double the volume again, crank the price up a little bit. He got so good at this, people would flock in, okay, to his fake bull runs and produce a real bull run. Okay, he could produce a synthetic short squeeze on demand for basically any stock on the planet. Imagine if the dude who was squeezing GME, right? What's his name?
Keith Gill.
Roaring Kitty. Yeah, imagine if Roaring Kitty could just do that to any stock he wanted on demand at any time he wanted.
He almost can, because like when he tweets, people buy. It's crazy.
Yeah, right. He almost can. But
we need to get this. We need to get this guy into TSSI now.
The reason he can move markets is because people listen to him. The reason Jesse moved markets is because Jesse convinced other people the bull run was real. Eventually, he got famous for producing fake bull runs. Okay, we had to form the SEC. The specific story I cited, where I think it was JP Morgan gave him a bunch of money, he actually didn't need to use the money the banker gave him, because the banker also made the mistake of telling other people that Jesse Livermore is going to get me out of the stock. And that news got out and it caused a rally. So Jesse Livermore got handed 10 million and the banker was like, get me out of this. Whatever you can do, get me out of this. And then Jesse's like, okay. And then like 3 days later, a rally happened and Jesse's like still planning what his moves are going to be. And he just sells into the rally and wins. Like his reputation alone moved markets.
He killed himself, I see.
Yeah. So he blew up his account 3 times in his life.
Oh.
3 times. And I don't just mean minor blowups. I mean, like, he went from higher liquid net wealth than any other person on the planet to higher debt than any other person on the planet in like a single day. And this happened to him a couple times. You know, when you trade on margin and stuff like
all
that.
in misty and margin level of blow up.
Well, so
we're 2 blow-ups away, Fiscal.
There are limits on how much margin you can take nowadays. There didn't used to be limits. So like you could take massive margin on a tiny position and lose like your entire net worth real quick. Real quick. So that happened to him 3 times. The first 2 times it happened, he paid back everybody. And the 3rd time it happened, he's like, I can't go through this again, and just committed suicide. So watch out for that margin.
Am I reading who the great-granddaughter is correctly?
Who's the great-granddaughter?
It's on Wikipedia at the
Brandy
right.
Love?
Yeah.
I don't know who that is.
I don't know who that is.
Yeah. Whoa.
Oh, now, because we all know who
That's true.
that is.
That's actually kind of crazy.
Yeah.
Small world.
So this is, you know, we had this momentum-based paradigm where everyone wants to buy things that are cheap and then they go higher, right? Very few people have a volume-based paradigm, okay? The market makers do, right? Everybody else has a momentum-based paradigm. You want to buy something, you want it to go up. You want to short something, you want it to go down, okay? In the 80s, something very magical happened. I want to say it was the fall of 1984, but it might have been like the spring of 85. Jim met Pete, Okay. And you guys have probably never heard this story.
Jim and Pete.
Okay.
Also,
James
Brandon Love
Dalton
doesn't get involved.
Oh, yeah. Well, so James Dalton was working at the Chicago Board of Exchange in like 83, 84, 85. And he was working on his own special version of technical analysis. Everybody wants their own special kung fu. Everybody wants their own branded secret sauce. So he's working on his own branded secret sauce. And he's on, like the third floor of some dark building, and he's getting lunch ordered to him every day. And then one day, a lunch boy comes in and he sets his lunch down and he looks around and he looks at all these crazy charts on all the walls. And he's like, you must be working on the same thing that guy up on the 6th floor is working on. And then James says, what? What do you mean some guy up on the 6th floor? Are you telling me somebody has charts that look just like mine? And the lunch boy says, yeah, let me show you. I just delivered to him like a week ago, and takes him up to the 6th floor. And up on the 6th floor is Pete. And all over Pete's walls are volume profile charts. And all over James's walls down in his office are basically volume profile charts. So calculus was invented by two different people at the same time. One in Germany, Leibniz, and one in Great Britain, Newton. Yeah. And volume profile was also invented by two people at the same time. Now, to be fair, Pete gets a little bit more credit because he published his book first. Right. So these two guys, they worked hand in hand once they met each other, right? Once they bumped into each other. I want to say Pete had already been working on it for 2 or 3 years. And James had already been working on it for like 6 months to a year.
Did the lunch boy work for Uber? That's my question.
Sorry, what?
Did the lunch boy work for Uber?
This was 1984 or 85, right in there. So I kind of doubt it. He was probably like pizza delivery or something. Yeah. Very few, or Chinese.
Maybe Pizza Hut.
Very few industries delivered in the 80s. So these two guys, they had very different trading mentalities. Okay, so for example, Jim, he's a momentum trader. He wants you to buy something and for it to move really hard. Okay. Pete is a mean reversion trader. He wants to identify a range, buy at the extreme of that range, and then hold until the price returns to like the middle of the range, and then he's going to sell into the middle of that range. Okay. These two guys have completely separate, very different trading strategies. Like oil and water, they do not mix. However, they both came to the same conclusion. Candlestick charts suck. Candlestick charts were invented 400 years ago in Japan. And I don't mean in 1710 when the futures market happened. I mean in like 1605 when the rice market blew up in Japan, and they're all just writing stuff down on paper. And it became easier, they realized, to mark the beginning price for the day, the end price for the day. And to the wicks above and below were there to note the entire range of the day. And this is how all those market makers tracked the price history, was symbolism. They invented the candlestick method as a way to symbolically track price action. The problem with the candlestick method is that it doesn't show you volume at price. It shows you volume versus time. Okay, and so when you look at a market where hang on, let me just pull up a volume profile chart. Maybe that'll be. Okay, so here you can see a candlestick chart and volume profile, one on top of another. Oh, and it's not loading. Great. Here we go. You guys see that okay?
Yeah.
Okay, so normally you're used to seeing volume on the bottom of the screen, right? That's trash. That's useless. Yeah. Don't do that.
I have heard from people who do technical analysis that you want to flip it so that
so these two guys figured this out in like 84, 83, 82, right? And separately, completely independently from each other. There's a huge amount of information here that is not available to you if you look at the volume across the bottom, right? Because here shows you volume at price, right? This shows you where participants decided was a fair price. completely independent of time. Well, it's broken up over multiple days and all that stuff, but they completely, absolutely revolutionized the tools that are available for trading, the technical analysis, right? So the whole reason I'm giving you this freaking 45-minute long spiel or however long is we suck at playing this game. We suck at playing this game so bad. We're 400 years into learning how to play this game, and we still don't even have good tools. That's how bad we suck at playing this game. The greatest revelation in tool factoring for the entirety of the history of this had happened in the 80s, freaking 40 years ago. 98% of market participants have never heard of volume profile and won't use it because it's not momentum. Like it doesn't. It's first off, it's a little hard to read. You have to read several hundred pages worth of book to understand like everything on here. But they've been sold this 3 easy steps to become a millionaire. Just learn this one indicator. This is not an indicator. This is just a completely different way of looking at markets. This is a statistical view, right? You're looking at a bell curve of volume over time, broken up over that day. It produces a specific bell curve. When I trade, I place specific bets based off of statistical probabilities, right? And I can choose my risk, and I can know what my risk is based off of where the trade is in the bell curve, how far it is from the volume point of control, how far it is out of the value area. The standard deviations away from the volume point of control give you estimates for expected volume out there, right? So if you know what the center of the bell curve is, you know how wide the first standard deviation is, you can just place a trade right out here and wait and be very confident it will eventually get filled because that's how bell curves work. Okay, so I highly encourage you guys to read some specific books. Okay, so let me talk about some specific books that are worth reading. The first book I'm going to talk about is not from a technical analysis guy. It's from this guy. Does he look like the most suave guy on the planet?
Pretty good looking guy, but I wouldn't.
I'd be worried about him amogging us.
Yeah. He's going to come in the room. He's going to take all the women. Yeah. So this man.
Leave a little pussy for the rest of us, bro.
for about 20 years, okay, the world's most wealthiest hedge funds and the largest firms were sending their traders to this guy. This guy was the shrink. He was the head doctor for the world's most expensive traders. They like the elites of the elites for like 15, 20 years, right in there. And he wasn't actually a psychologist. His actual background, he spent 9 months as a trader and got so wrecked he quit trading, right? So this is not a guy who's like, I've made $6 million trading and I'm the most successful trader ever. You need to send me your traders. I will coach them to be successful. No. This guy says, I failed so hard, so bad, and so quickly that I took notes on it and I started writing a book on it. And then my employer, the brokerage, found out that I was writing a book on it and they fired me. So that's how he ended up as a coach. Was he was dead broke because he lost all his money trading and he got fired. And he's like, I don't know what to do with myself. The only thing I really understand is that nobody understands how to navigate markets. So this guy's name is Mark Douglas. You can look him up. He is not at all even remotely famous. He used to charge people $10,000 a day per seat to sit in on his seminars. Yeah,
that's the real grift. We got to get into that.
Okay. Well, so here's the thing. He did this for like 20 years and people kept going back over and over. And he's so good at it that people would like, no, you don't understand. You got to send your people to Mark. Your best traders, send them to Mark. They need to spend a day listening to Mark. So these seminars are powerful. Okay. How do I know they're powerful? Did I spend $10,000 to go sit on one? No.
A lot of channel memberships to that money.
Yeah, he retired and he's no longer trying to sell like seats at a seminar. So something like 10, 15 years after he stopped giving the seminars, he posted them to YouTube. So right now you can type in on YouTube, not right now, because we're in the middle of a podcast, but yeah, right now your entire audience can open a new tab and type in Mark Douglas seminar. He wrote at least one book called Trading in the Zone. You want to go read the book? Fine, probably good advice. But what I really recommend that everybody in this modern age do with TikTok and short attention spans is go listen to his 4 to 6 hour long seminars. There's like 3 of them on YouTube. He basically tells the same stories 3 different times, 3 different ways, hitting on the same major plot points. Again, all he talks about is psychology. If you want to be good at trading, if you want to actually understand technical analysis, it's not the indicators, it's psychology. You have to understand psychology. So you guys, you wonder why I'm so cool as a cucumber and I'm never going to panic sell. It's because I've listened to this guy. Yeah. So he talks about how when you make your decisions to buy and sell, and this is true for both investors, right, and traders, when you make your decisions to buy and sell, you need to do it from a cool, calm, collected, neutral state of mind. You do not need to be excited. You do not need
like
to be
Joseph Carlson.
Yeah, you need to be bored.
Like the Terminator.
The best time to make a buy or a sell is when you're bored. You need to be making evidence-based decisions, not emotional-based decisions. Right?
Yes, I'm sorry.
You need to stick to your plan. Whatever your plan is, make sure it's a good plan. Stick to the plan. Okay. So he talks about if you let this happen to me. I once took $100, and so this is back when I was learning how to trade options, real well, trying out a bunch of different strategies. So I put a small amount of money in a small account, right? Get it approved for options trades. Go do some small options trades. One of them, I started with $100, and then maybe 2 weeks later, I had turned that into $1,000. Very happy with myself. The following day, made $300 on a single trade. I was like, man, this was just $100 like 2 weeks ago. Super euphoric. The following day, lost about $600.
Ooh.
Yeah. What was my mistake there? I was not trading from a neutral state of mind. I was euphoric. See, when you are euphoric, you are blind to risk. And when you are fearful, you are blind to opportunity. So like these core concepts that Mark very thankfully passed on to me is part of the reason I'm so cool as a cucumber when it comes to like high tide. Because I know, I have all of the weight of, Warren Buffett and Charlie Munger and Monish Fabrai telling me, this is a value play. Don't you worry about it. Company's already undervalued. It's getting more valuable every year. Just hold on. I also have Mark Douglas over here saying, man, if you are going to buy or sell, make sure you do it on a day that you don't care, that you're neutral, right? Cool, calm, neutral. That is when you should be buying and selling. FOMO is your worst enemy. If you're feeling FOMO, just like buy a single share.
Yeah.
Just to get the FOMO out of you. Like don't go FOMOing in with large size. Okay. Also, for example, I noticed both of you have been excellent about this. Both of you, great job. I come on here, I tell you about a fantastic new company, great opportunity. You start a very small starter position. You don't go like, oh man, 20% of my portfolio into this great new thing. It's like the stock market is the one of the few places that people will hear a hot tip, overhear a hot tip somebody gave to somebody else on a bus, and then rush home and buy stuff without researching.
Yeah.
And it just doesn't make any sense. Like this stuff happens on slow time frames. You can buy stuff and wait years for your returns, or your actual losses to materialize. You don't have to just rush out, right? Everything happens in a slow time frame. Okay, actual books, right? I've been ranting along. So here's Mark Douglas, Trading in the Zone. It's like $50 hardcover. Mind Over Market.
25 memberships, guys.
Yeah. Mind Over Markets. Okay, this is literally the driest book I have ever read in my entire life. It's a really good book. I highly recommend everyone who wants to get into trading, or if you want to get into investing long term, like actively investing, not passively investing, where you're entering in and leaving positions. This book is great for that. It's like maybe 600 or 800 pages, something like that. It's really long, and like I said, dry, really dry. And I'm an engineer. I read dry books all the time. This is the driest. So James wrote this one. Pete wrote this one. Stoudemire on markets. Trading with Market Profile. This book is a little bit shorter than Mind Over Markets. Mind Over Markets covers some additional information that was not in this book. This book came out first, right? So the two guys sort of stumbled into each other. They developed it sort of together, working in tandem, bouncing ideas off of each other, a lot of that. And Peter Sittlemeyer here, he launched his book first, and then James did his like 8 years later, something like that. James's book is more comprehensive, okay? This book, more comprehensive. How did I find out about volume profile, right? How I found out about volume profile is I'm doing all this research on technicals, right? 2020 pandemic, it's like April. I've been sitting on my couch for 2 months straight with nothing to do, just really bored. And I had just got done trying to teach myself literally all 400 of the indicators that are in Thinkorswim. I was hoping maybe I could find one that would be good for a value investor. Didn't find one. Long story short, no good. Many of the popular ones have uses, like RSI and MACD and EMAs. They all have uses. I'm not going to say they're all trash. If you have a very clear framework to work from and you have a clear boundaries, all of those indicators can do well, okay? A book like this is going to give you a framework. It's going to give you boundaries, okay? So this is a much thicker, denser read. It's much more comprehensive. How I found this book is I was doing research and I eventually found someone on Reddit. This is how the door first opened. He was bitching that the firm he had just been hired into, okay, was forcing him to read this book and they were treating it like the Bible. And he was pissed. And then a week later, he reposted on Reddit that actual James Dalton showed up to his company and spent a half a day talking to them about trading. Like, that's how serious the firm he was working for was treating this book and James Dalton. And so similar to the whole, like, the finest traders in the industry think this guy knows what he's talking about, they also think that James and Pete were onto something. Okay. Now, since then, the Medallion Fund has come out. Actual quant traders have revolutionized what it means to be a quantitative trader and to run a quantitative strategy. But these two guys really tapped into something that us retailers, right? Retail, we get sold wholesale stuff all the time. Us retailers can actually use. And without a supercomputer, without a massive AI quant strategy, you can also look at markets using statisticals. Using the bell curve. I think that's kind of the end of my speech. Let me stop sharing and just chat. So who's got questions? I just ranted about TA, the history of TA for like an hour.
man, this almost should have been a members only because it's like a whole lecture on the history of technical.
The real value is the hour 36 the viewership gets.
That's amazing.
So who's got questions? I can answer some questions, not all of them. I don't claim to have all the answers.
So do you do any technical trading nowadays at all?
No, because I'm too busy. So I work 7 a.m. to 5 p.m. And then so when I get home, everything's closed. And then I get out of work early on Fridays, and usually like Friday would be my only opportunity to like day trade.
Yeah.
And it's always like I gotta go run errands, groceries, laundry. Like my weekend has to start, and my weekend is not go to the bars. My weekend
there's a natural follow-up to that then.
Yeah.
Like how much time, like if somebody wanted to actually do this consistently and wanted to be consistent and good and so forth, how much time would they have to spend per week doing it then? Since you cite time as your constraint, then clearly it's not something you can just kind of half-assed do from your phone while you're at work if you have a real like intense job, right?
So I heard 3 questions there. I heard how long does it take to get good, and what does my trading setup look like? And it's not from my phone. How long does it take to get good? How many hours a week are you willing to throw into this? Are you the right personality type to actually be able to get good at it? I am an INTJ. You can. I want to encourage the entire chat to type in what is an INTJ. Okay, it's a personality type. We're really rare. We're good with like solitary confinement and stuff. Like you throw me in solitary confinement, and theoretically, according to my personality, I come out 3 weeks later and I'm just a little bored, nowhere near at risk of like actually going insane, where most people would just driven straight up the wall. So depending on your personality type, some people are already hardwired to be better at dealing with like the inconsistency of the volatility and all that stuff, the psychology. Okay. So I can't give you a flat answer on that. Most traders that I've come across, somewhere around their third year, they finally become consistently profitable. And a lot of that, what I hear is different from the truth. What I hear is you just need to put in more screen time. You need to burn more patterns in your brain. Remember, we're pattern recognizers, right? So a lot of these coachers pushing this TA, they're pushing the indicators, they're selling a scam, right? They are selling alchemy. Okay. Actual chemistry is available. People could go learn real technical analysis. They could go become like a chartered market technician, anything. Actual chemistry is available, and people still choose to go purchase the alchemy, and they spend $10,000 for the alchemy, and they think that that's going to get them somewhere. It's not. Okay. So if you go down the wrong path and you start paying some scammer for alchemy, it can take you a lot longer than 3 years to become consistently profitable because you started on the wrong path. Okay, the fastest I've ever seen anybody become like zero trading skills to actually really good was 6 months, and they were a professional poker player. So they already had like 80% of the skills that you need to be good at trading. Anybody who's good at poker. Okay, so what does my trading setup look like?
That's what I was doing when I was in my late teens.
Yeah, no, you should. If you already have a good poker mindset and you already understand that, like, you know, law of large numbers and probability and risk, and you really need to like
variance.
Variance. You really need to push many small trades, right, to actually become consistent. You don't become consistent taking like one trade a week. You take 200 trades a week. That's how you find consistency. Many small trades.
On the weekly, though, like how many hours would you have to spend a week to make like a worthwhile amount of money, do you think?
Oh gosh. So developing the skill versus using the skill. Developing the skill, we're talking somewhere between 200 and 2,000 hours.
To develop the skill. So, and that could be over some extended period of time.
Yeah, over like 2 to 3 years is what I expect for it to take most people.
But I mean using though, like to actually, like, let's say you were trying to replace your income at your W2 job.
15 minutes a day. Yeah.
15 minutes a day.
Yeah. So when I first got hired full time, and I wanted to keep trading, right? So I leaned back onto a strategy that I used to use in like 2014, 2015, right in there. I wasn't very good at trading at the time. So I was trading OTC penny stocks, and I was flipping prices based off of like the intraday volume from the day before. But the problem with OTC penny stocks is there's very low volume and the prices are very low. And so the dollar volume available to you is very low. So I was only able to flip very tiny trades, right? So if I wanted to make significant money, like let's say I wanted to make $200, right? If I'm only making like $10 on each trade, I have to place 20 trades. So, and if I want 20 trades to actually execute, I have to place more like 40 to 50 trades in order to get 20 trades to actually execute, because when I place my limit buys and my limit sells, I'm not risky, I'm cautious, right? Because I understand. Yeah, so I push my limit buy down, and then I push my limit sell down, and then now all of a sudden I'm expecting market volatility to sweep through my buy, get filled, and sweep way past my sell and get filled, and I'll walk away with a small profit. So I was doing that and I'm talking 50 trades a day, something like that. And I had to walk away from that because the act of trying to find 50 trades a day that I could place like the night before and then go to work and then come back and then check on them the next day, it was like 3 hours of work. And I'm not really interested in doing a full day at work, like going and doing a 10-hour day and then coming home and doing a 3-hour day. Like I'm not all about that life. Like I'm a low stress guy. I really try to emphasize low stress. So if I ever quit or get fired, I will absolutely immediately go right back into day trading, because it's a skill that I polished it up to the point that I am consistently profitable, but I am not happy when I lose. Okay. So my problem is psychological. I get really pissed off of even small losses. And it's unhealthy, which means, I might trade 3, 4, 5 days in a row and then take a loss and have to not trade for several days. And so it's basically impossible to turn that into a career because I put myself on tilt a little too often. And so it's my last barrier to just quitting my job and trading every day is myself.
Yeah.
It's not the skills. It's
See,
my
what you need to do to inoculate yourself against that is there's a stock called MPW. You need to
All right, no, that's enough.
just get accustomed to holding that, and you'll get used to tolerating losses.
Yeah.
So
actually, it's I'm almost back into the green on that after this journey now.
So I have two basic like trading setups that I would use for like what I look at when I'm trading. Okay. The method of trading that I talked about earlier, where I'm placing the trade the night before, like it's like 8 p.m. at night, and I'm placing limit buys for the next day. Okay, that's done usually using Fidelity, because Fidelity will let me look at the entire previous day's volume at price. Each individual order, the size of the order, what the bid was at the time, the size of the bid at the time, the size of the ask at the time, what the ask was at, every single piece of relevant information related to the tape, Fidelity will show you if you know where to look. You just got to go look into the book, and it will show you old prices from the previous day, last week, 6 months ago, all that stuff in hyper fine detail. So I was looking at that information in order to determine my limit buys and limit sells, and everything is like statistical. The other trading is day trading, and I mean full-blown degenerate. I've got like 18 indicators across 4 screens. I'm trading the SPY. I'm trading options on the SPY. I'm looking at the trend. Oh gosh, I'm looking at the tick. I'm looking at the ADD. There's about a dozen different indicators that I look at that most people don't even know exist. And I'm not looking at derived market indicators based off of price, because every single one of those is lagging. EMA, lagging. MACD, lagging. MACD is literally a lagging EMA with an even laggier EMA slapped over it. So almost every retail indicator, okay, I'm going to emphasize this. The indicators that get pushed to retail are crap. Every one of them is crap. If you want actual indicators, you need to go look at predictive indicators and real-time indicators, because they can show you what's going on right now. The trend, the ADD, the tick, these exist below the stock market, and they give you feedback as to what's happening in the actual surface. It's the strength of volume, the strength of dollar volume, the number of risers versus the number of sellers. The tick will show you the heartbeat of the market. It's a little complicated for me to explain what that means, but once you see it a few times, you know what I'm talking about. The market has a rhythm. There's multiple rhythms. It's fractal. You can see multiple rhythms on the tick. You can see it. So the indicators that I use, I do not use lagging indicators except the MACD for like a confirmation signal and stuff like that. But there's spaghetti. You can call it spaghetti. There's spaghetti all over my screen, but it's not the spaghetti everybody else uses. When I'm day trading, when I'm like doing the calm, systematic, it's 8 p.m. at night trading, there's like nothing on my screen. I'm looking at chains of numbers and like pulling, like pareidolia, I'm just pulling patterns out of the numbers to choose my limit buys and limit sells.
JJ kind of
I'll defer my question to JJ because we're at like hour 47 mark here.
So I mean for somebody that's working full time, like, yes, I think it would be challenging to put in the necessary effort to learn and then to actually intraday trade while working those hours. Now, funny enough, my work starts after the market closes, so technically speaking, like, I could,
everybody.
if I never wanted to sleep or have any time to myself, I could for sure do that. But yes, like it does seem like it would be quite an undertaking for most people, and this is why so few people are successful at it, I would think.
I've heard it's about 3%. About 3% of people who get into trading are actually good at it. And it's closer to 1% of people who get into trading are actually still trading 5 years later. Meaning 99% gives up and just goes home. Like they get up, they dust all the broken cookies off their clothes, they pick up their teddy bear and they grab their little red wagon and they storm out of the room because they have been hosed by the market, humbled by the market way too many times, and they're not ready to get beaten up one more time.
Yeah. So, yeah, I mean, I think it's important for people to understand that even if there is something real behind like the concepts in technical analysis and trading, if it was easy, everybody would be making gazillions of dollars doing it, and that you just don't see that in the real world.
Correct.
Despite what the people on social media try to, sell you on.
If it was easy, I wouldn't have a day job.
Yeah.
Like I just want to be super clear. If this was easy, I wouldn't work.
And in a bull market, everybody thinks it's easy and everybody looks like a genius.
Yes.
Yeah. And I wasn't kidding. 15 minutes a day. Like the story I was telling, like I started with $100 in that particular account. And like 2 weeks later, it was over 1,000. The following day it was 1,300. The following day it was 700. 15 minutes a day.
Yeah.
Like if you polish this skill well enough, you really can revolutionize your life. Unfortunately, a majority of humans are not cut out for this. And even if you are cut out for this, are you willing to put in the work? And even if you are willing to put in the work, do you have the right personality for it?
Yeah.
Like, are you willing to accept that instability that comes with it?
What percentage of the kids that make the high school basketball team could cut it in the NBA? Like very few. Like, and I feel like it's a very similar barrier to entry. Like, how many people can, open a brokerage account and, place a few trades? A lot of people, but very few can do this at the level you would need to make a full-time income or more.
I am very strongly considering getting back into selling options because it's one of the few activities where I can do all of my research the night before. And then on my lunch break, pull out my phone and just already know what strikes, what prices, like a very clear picture of what my goals are. And then I could trade like on my lunch break every day. I've thought about this.
Options selling a little bit less blow up risk.
A little less
when they're covered.
I tend to favor like hedged options trades, and most people they just like sell. I hate to use the word naked. It feels naked. It's covered with money, but it's not hedged. Most people sell unhedged puts. Yeah, they sell cash secured puts. Yeah. And very frequently, instead of selling a cash secured put, I will enter a short put spread, like a short put ratio spread, where I am long a put and then short multiple puts below it at cascading strikes down there. So the strikes, like the puts that you sold down here, pay for the put that you're long up here. And you just make sure that the arbitrage has a tiny gap so that it's like whether it's a debit spread or a credit spread, you get to choose that. And so I just always set it up so it's like, okay, well, I'm going to collect like $5 right now, like almost nothing. And then if things go well, this hedged position could make me significant money. And if things go horrible, I'm not out any money. So whatever. And so like those are the types of options trades that I prefer are like hedged and not super profitable. Because remember, Blake hates losses.
Yeah. We are nearly 2 hours deep on this episode. I will
buy High Tide.
I'll do the honors. Yeah, High Tide took a bigger chunk than I thought, but I think it was a good conversation. Blake, where can the viewership find you?
Well, you'll find me here very shortly after the next High Tide earnings report. I'm still in the process of moving. God, it's taking forever. Whenever I'm done with that, I'm planning on starting a new thing where I stream on Twitch. And I'm going to stream myself researching companies. And it's going to be very boring and very dry. I'm probably only going to have like Dissector as an audience member. Basically like my one fan. But then I'm going to chop that up and put like compressed, edited like results of my research. I'm going to post those to YouTube. And I'm going to try that. So where can you find me? You can find me in the future. You can find me here. I believe last time I cited I was going to be selling High Tide at like $30 a share, right? Yeah. You can find me doing that.
$6. No.
Yeah, I wouldn't sell at 6. I'd probably still
I
be
know.
a buyer
Wait for
at
the
6.
mega rally.
Yeah.
Yeah, I'm waiting for the actual rally. 6 is not a rally. 6 is what normal people consider a rally. I mean, 30% drop is just a Tuesday for me. So like 6 is
just like Raul Julia as Bison. Yeah. For me, it was Tuesday.
Yeah, it's just Tuesday. Yeah. Well, like we had the interview with Raj, and then it ripped 60%, and I'm like, and people ask me, "Are you going to sell? Are you going to sell?" I'm like, "Are you kidding me? I want to buy more."
There's only one.
All right, after we pumped the stock, yeah. God, maybe we need to do it again. Once again, check out Strongman Tax Services. The link in the description. If you would like personal filing from your taxes from a veteran-owned business, do you want to support the vets? If you don't do it, I think you're a piece of shit.
He can do your personal taxes, and if you have a partnership or S corp or business entity, he can do your business tax.
Yeah, if you're one of the 14 people or 42 on Twitter and YouTube still deep into this, you're a piece of shit if you don't do it. I'm joking, but I would support the channel. Tell them you came from the Cashflow Kings, and links in the description.
I do want to pipe in because I do my own taxes every year. You should probably separate your trading brokerage account and your long-term investing brokerage account, because it sure does make doing your own taxes a lot easier.
Yes.
All right. I send all mine to the CPA. God be with him.
All right. Thank you all for tuning in. We'll be back live next week. Smash the like button, subscribe, do Dividend Stocks and Drugs, and of course, cash flow is king. Oh, yeah.